stop for a moment, put the coffee down, close the extra tabs. Look at the price on your screen. What do you see around $71? Quiet, stable, reassuring. That number is doing its job. It's keeping you calm. Now here's the problem. If you trade charts, you're probably telling yourself silver is consolidating, holding support, behaving normally. But that price is not reality. It's a signal from a paper system that no longer reflects what's actually happening on the ground. While the West stares at screens, the physical market in Asia is telling a completely different story. In Tokyo, real silver metal you can touch, not contracts that settle in cash, is selling at prices equivalent to roughly $130 per ounce. Not because of hype, not because of speculation, because that's what people are willing to pay to get out of currency risk. $71 on paper. $130 in the real world. That gap is not friction, it's not tax, it's not shipping. An 80+% spread is not inefficiency, it's a fracture. When paper prices and physical prices separate like this, it means the mechanism connecting them has broken. The spot price is the price of promises. The street price is the price of certainty. And history is very clear on this point. When those two diverge, paper always chases reality, never the other way around. This is not the collapse yet. This is the warning. And if you understand what this gap really means, you'll understand why it's not closing and why what comes next will catch most people completely unprepared. If this already shifted how you see the market, comment one below and make sure you're subscribed. At this point, the skeptics start talking. I can already hear them. They say Japan has taxes. They say minting costs money. They say shipping metal across the ocean isn't free. And on the surface, that sounds reasonable. Friction exists in every market. But friction does not cost $60 an ounce. Even if you stack every possible expense, fabrication, insurance, transport, taxes, you might justify $10. Maybe $15 if you're being generous. That still leaves a massive hole in the story. So the real question isn't why the price is higher in Tokyo. The real question is why the gap hasn't been closed. In a functioning market, this would be the easiest trade in the world. If silver is $71 in New York and $130 in Tokyo, the biggest banks on earth should be printing money. They should be buying metal at the paper price, shipping it east, and locking in risk-free profit by the ton. $30 million here, $40 million there. Banks do not ignore that kind of spread. So why aren't they doing it? Because they can't. The arbitrage mechanism, the plumbing that connects paper contracts to physical delivery, is broken. Large industrial bars sitting in Western vaults cannot be converted into retail product fast enough. Refining capacity is limited, secure transport is constrained, and most importantly, the silver in those vaults is far less liquid than the system pretends. If a major bank tried to pull tens of millions of ounces out of the exchange today, it wouldn't trigger a shipment. It would trigger a cash settlement. The system would force them to stay in paper. The bridge between the two worlds has burned down. This is what bifurcation looks like. Two prices, two realities. In the paper world, silver is cheap and abundant. In the physical world, it's scarce and expensive. And the longer this persists, the more dangerous it becomes because it tells us something critical. The market is no longer self-correcting. And when markets lose that function, they don't heal quietly. They snap. When people see this kind of divergence, they jump to the same conclusion: the banks are finished. I see the headlines already. JP Morgan is trapped. The shorts are dead. This is the end. It's a satisfying narrative. It feels like justice, but it's also dangerous because it's incomplete. Yes, the banks are under pressure. Yes, they are bleeding. But no, they are not about to collapse tomorrow. Let's talk numbers, not emotion. The bullion banks hold a massive short position in silver through the futures market. On paper, it looks catastrophic. A move from $71 to $100 creates billions in mark-to-market losses. For a hedge fund, that would be fatal. For a systemically important bank, it's painful, not lethal. These institutions are armored with capital. Hundreds of billions in Tier 1 buffers exist for exactly this reason, to absorb shocks. A multi-billion-dollar loss ruins bonuses, destroys quarterly earnings, and gets traders fired. It does not automatically shut the doors. And there's another uncomfortable truth most people ignore. Banks are not gamblers, they're bookies. What looks like a naked short is often hedged elsewhere in opaque, over-the-counter deals with miners and refiners. Losses in one pocket are frequently offset by gains in another. That doesn't make them innocent, it makes them durable. What they are facing is not a solvency crisis, it's a liquidity squeeze. They need cash to meet margin calls while waiting for hedges to pay out. That distinction matters because liquidity problems buy time, and time is their greatest weapon. This is why betting on an overnight collapse is a mistake. If you assume the banks die tomorrow, you will over-leverage, rush, and get shaken out. The institutions can endure far longer than most traders can remain solvent. The war isn't ending, it's changing shape. This is where expectations become dangerous. Many people believe that once the system is exposed, price action should explode straight up. A vertical candle, instant justice. But markets don't move on morality, they move on control. And while the banks are losing control of direction, they still control the battlefield. Direction is physics, control is strategy. The supply dynamics now demand higher prices. The shortage is real. The divergence is real. But the speed of that move is still being managed. The institutions still set margin rules. They still run the algorithms. They still own the casino. And their goal is simple: make this as painful as possible for anyone using leverage. The first weapon is volatility. Expect violent swings, $5 up in the morning, $7 down by the close. Not because fundamentals changed, but because fear creates liquidity. Sudden drops force leverage traders to sell. Stops get hit. Positions are liquidated, and every forced sale helps the banks reduce exposure. The second weapon is boredom. After a sharp rally, price will stall. Weeks of sideways action. No headlines, no excitement. This phase is designed to exhaust conviction. They want you distracted, chasing something else, convinced the move is over. Then without warning, price jumps again. This stair-step pattern isn't random, it's deliberate. Rise, chop, smash, repeat. Each cycle removes weak hands while allowing institutions to reposition quietly. The banks aren't trying to kill the rally anymore, they're trying to survive it. That's why this isn't a sprint. It's a grind. A slow bleed where patience beats prediction. Those who expect fireworks will panic at the first engineered drop. Those who understand the process will recognize it for what it is, a managed retreat. And while paper prices whip around violently, something else keeps happening in the background, something the banks cannot control, slow down, or reverse. The physical supply continues to disappear. That's the pressure point, and that's where this story turns from financial engineering into something far more dangerous. Up to this point, everything we've discussed lives inside the financial system: balance sheets, derivatives, algorithms. But the real threat doesn't come from spreadsheets, it comes from physics, from metal that either exists where you need it or doesn't. This is where the narrative changes. While traders argue over charts, a structural supply shock has quietly taken shape, one that cannot be hedged, printed, or regulated away. China, the largest producer and consumer of refined silver on the planet, has shifted its priorities, not rhetorically, legally. What's being described as export licensing is not a minor policy tweak, it's a gate. Smaller refiners, scrap processors, and trading houses, the entities that once fed excess silver into global markets, are now effectively locked inside domestic borders. Only state-aligned giants can export, and their mandate is no longer profit. It's security. China consumes far more silver than it produces. Solar manufacturing alone demands enormous volumes, and next-generation panels use significantly more metal per watt. That internal deficit means one thing: there is no surplus to export. Every ounce is spoken for before it leaves the refinery. This isn't temporary, it's structural. For decades, Western markets relied on Asian supply to smooth shortages. That release valve is gone. And when a global market loses a major supplier, prices don't adjust gradually, they rewire. Now, industrial buyers aren't ordering just in time, they're ordering just in case. Hoarding begins. Safety inventory replaces efficiency. And once that behavior starts, it feeds on itself. Banks can manipulate paper. They cannot force a refinery to export. They cannot print bars. And they cannot reverse a geopolitical decision with leverage. This is the variable they can't control. And it's why the pressure keeps building regardless of what the charts say. Because when supply stops flowing, price stops being negotiable. When people talk about silver availability, they usually point to the wrong number. They look at total inventory and tell themselves there's plenty of metal. That illusion is deliberate. The real story is buried deeper in a category most investors never bother to understand. Registered inventory. This is the silver that actually matters, not silver that meets purity standards, not silver that exists somewhere in a vault. Registered silver is the metal that is legally available to settle contracts. It is the last line of defense between the paper market and outright failure. And that line is dangerously thin. Right now, the amount of registered silver sitting inside the system represents less than 2 weeks of global consumption, not months, not years, days. Everything else, the so-called eligible silver, belongs to private owners who are under no obligation to sell. The banks cannot touch it. They can't commandeer it. They can only hope someone volunteers. But ask yourself an honest question. If you owned silver and you saw the real world price climbing far above the paper quote, would you hand it over at a discount or would you wait? That's why the eligible pile is frozen. It exists, but it doesn't circulate, which means the entire pricing system is balanced on a shrinking pool of deliverable metal that's being drained every single day. This is not accidental. It's mathematical. When a commodity is priced artificially low, demand doesn't disappear. It accelerates. Buyers rush to the cheapest source on earth, and right now that source is the paper exchange itself. Standing for delivery is no longer an act of speculation. It's an act of rational purchasing. And every ounce that leaves tightens the clock. This is the countdown most people never see. Not a timer on a chart, but a physical limit. When that registered number approaches 0, the system doesn't adjust. It protects itself. And protection in this case means one thing: cash settlement. When most people hear the word default, they imagine chaos, markets crashing, headlines screaming. That's not how modern financial systems fail. They fail quietly behind legal language and procedural adjustments. If registered inventory runs too low, the exchange doesn't panic. It invokes the rules. Physical delivery gets temporarily suspended. Logistics are blamed. Market stability is cited. Force majeure is declared. On paper, everything is orderly. In reality, it's the moment the promise breaks. Instead of metal, contract holders receive cash, the official spot price, the very currency they were trying to escape. And by the time that happens, the real market has already moved on. This is the trap. A cash settlement isn't a refund. It's a denial of access. While you're handed paper at $71, the physical price gaps to levels that no longer care about charts or fairness. You didn't lose money on paper. You lost purchasing power. That's why this isn't just a pricing event. It's a separation event. Those holding promises stay inside the system. Those holding metal step outside it. And this is where psychology takes over. The moment headlines hint that delivery might be constrained, behavior changes instantly. Industrial users scramble. Funds that never cared about physical metal suddenly demand it. Inventory doesn't drain slowly anymore, it vanishes. We've seen this before in smaller markets, nickel, palladium. When confidence breaks, the exit is not wide enough for everyone, and the silver market is far smaller than most people realize. The irony is brutal. The cheaper the paper price stays, the faster the physical disappears. Suppression accelerates its own failure. This isn't the end yet. But once cash settlement becomes even a possibility, the game changes permanently. Because no one who understands this will voluntarily stay trapped on the wrong side of that line. And that brings us to the most important question of all. What should you actually do? This is where most people make their biggest mistake. They confuse urgency with panic. They see headlines about triple-digit prices overseas and feel compelled to act immediately at any cost. That instinct is understandable, and it's exactly what destroys capital. Paying an extreme premium is not strategy, it's fear. When buyers in Tokyo pay 80% over spot, they are not making an investment decision. They are making an escape decision. Their currency is collapsing, and price no longer matters. You are not in that position, and that gives you an advantage. Your edge exists because the manipulation still exists. The banks are holding the paper price down to protect themselves. In doing so, they are subsidizing your entry. Every time the spot price is pushed lower, the physical buyer outside the panic zone gets a discount on reality. Think about the math. $71 plus a modest physical premium puts real metal in your hands for far less than what the global market is already signaling. Same element, same utility, same scarcity, different price for now. This opportunity only exists in one narrow window before the system admits the truth. And here's the rule that cannot be bent. This strategy only works if you hold physical metal, not paper, not ETFs, not unallocated accounts. Those are promises inside a system that is already preparing its exit clauses. Unallocated silver is not silver. It's a liability. You are an unsecured creditor lending capital to an institution that is structurally short the asset you think you own. When stress peaks, that claim is settled in cash, not metal. Physical ownership removes counterparty risk completely. No margin calls, no rule changes, no forced settlement. A bar in your possession does not care what the exchange declares. The premium you pay is not a fee. It is insurance against being trapped on the wrong side of the system when the rules change. This market is not rewarding clever trading. It's rewarding correct positioning. And that positioning becomes critical as we approach the final phase. The mistake most people make is assuming this ends with a single dramatic moment, one candle, one headline, one overnight repricing. That's not how systems unwind when the participants are powerful and motivated to survive. What's coming is a grind. The price will move higher but not cleanly. Sharp rallies will be followed by sudden drops. Margin requirements will rise without warning. Volatility will be weaponized to exhaust anyone relying on leverage or short-term conviction. This isn't randomness, it's filtration. Every spike shakes out the impatient. Every crash transfers ounces from weak hands to strong ones. Meanwhile, the physical side keeps tightening. Inventories don't recover. Supply doesn't magically appear. Industrial demand doesn't slow just because price action becomes uncomfortable. The divergence widens quietly even on days when the chart looks ugly. This is the phase where narratives flip constantly. One week the rally is over, the next week it's unstoppable. That confusion is intentional. Confused participants make mistakes. Disciplined ones accumulate. Eventually a line is crossed. Maybe it's inventory, maybe it's delivery stress, maybe it's a geopolitical escalation. The trigger won't matter, only the positioning will. When the system finally concedes, the adjustment won't ask permission. By then, paper price targets won't matter. The market won't be debating 71 versus 80. It will be debating availability, and availability doesn't negotiate. Those holding metal will not need to sell. Those without it won't be able to buy. That's how repricing actually happens, not through charts, but through exclusion. The question is not whether this phase ends. It's whether you endure it without being shaken out before it does. Because once this transition completes, there is no reset. There is only the new price. Chapter 10. The strategy, the lesson, and the final call. Everything we've discussed leads to one unavoidable conclusion. This is not a trading event. It's a structural shift. The silver market isn't mispriced, it's breaking under the weight of reality. And when systems break, they don't reward speed or cleverness. They reward preparation. The core lesson is simple, but uncomfortable. Paper promises are fragile. They depend on rules, trust, and uninterrupted logistics. Physical assets depend on none of that. When stress rises, the system always protects itself first, not the participant. This is why the winning strategy is not leverage. It is not timing the perfect bottom. It is not chasing headlines or waiting for confirmation that comes too late. The strategy is positioning before the rules change and then having the discipline to sit through discomfort. Ignore the noise. Volatility is not a signal to exit. It's a signal of stress. Focus on ounces, not dollar quotes. Prices will move violently, but scarcity moves in only one direction. When supply, contracts, and demand becomes inelastic, repricing is not a possibility. It's a requirement. The greatest mistake you can make is believing this window stays open forever. It won't. Once the system is forced to acknowledge physical reality, the discount disappears. There is no second chance at the same terms. History doesn't repeat gently. It compresses outcomes. Those who prepared early look calm. Those who waited feel blindsided. So here's the final takeaway. Do not buy panic. Do not chase fear. Use the distortion while it exists. Hold what cannot be diluted, rehypothecated, or settled away. When the dust clears, charts won't matter. Ownership will. If this analysis gave you clarity, make sure you subscribe, like, and share this with someone who still trusts the number on their screen. And if you've made it this far, comment 1 below. It tells me you're thinking long-term, not reacting short-term. The system is changing, the strategy is set. I'll see you on the other side.